Hit it.
It's Friday, August 12th, 2022, episode 191. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome back to the show Barry Knapp from Ironsides Macro. Whether it's Barry's take on inflation, his view on finally agreeing with Neel Kashkari about something, or what he expects for the rest of 2022 for the stock market, you don't want to miss this episode. Then Patrick demands to be taken seriously with his technical mumbo jumbo. It would be a lot easier to do if he didn't have a mouthful of crayons while he did it.
We end with our segments of no stupid questions and skin in the game. And folks, we might even drink some beers along the way. So stick around. We got a great show. Lena, hop on. What beer am I drinking today?
So today, Patrick is drinking Ophiosa Brewing Company's Momotaro Peach and Passion Fruit Smoothie Sour.
Ooh. So what I did was I went to this local craft brewery near here, and I said, give me the craziest summer beer that you have. And they gave me this one, and they insisted that I had to pour it into a glass to drink it. So I'm going to quickly do this.
you tell them, no, I'm Canadian and I don't do that. It's against our religion.
That's it. Wow, this is.
I usually just shotgun beers off the floor of my parking lot. Is what you should have told them.
This literally looks like a fruit juice.
It sounds delicious.
Oh, it's pretty good. Oh, yeah.
All right.
I like it. All right, Kev, give us some side effects.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include vagal vasectomies, quantitative queefas. That should be queefs. And bowel obstructions.
You know what? The Vega got me this week. It got me.
All right. Let's go and chat with Barry. It's our great pleasure to welcome back to the show Barry Knapp from Ironsides Macroeconomics. Thanks for coming back, Barry.
Thanks for having me.
It's a terrific time to have you because there sure is a lot going on in macro, even though the volumes out there are terrible in terms of people trading. But like when it comes to the actual macro environment, it's changing all the time. And one of the things that, let's just jump right into it. We had recently the CPI number. It looks like maybe that's peak inflation. Is that how you read it?
I do. The market's picked up on peak inflation all the way back in April. At that point, the 2s, 10s inflation break-even curve was very deeply inverted. That's why the 2s, 10s nominal curve first inverted. And there was evidence as early as back then that we reached the maximum impulse. It's taken some time to work through the numbers, but when I go through the CPI report this week, first of all, it was amusing from a political perspective with the Biden administration calling it zero inflation and getting taken to task for that. Even Fed officials wanted to back off of that, given the egg they have on their face from the transitory forecast. But when you look at the quarter-on-quarter numbers, so I just call that inflation momentum, you saw a decided slowing in energy prices for sure. But you saw a decided slowing in core CPI on a quarter-on-quarter annualized basis. It was below 2%. You also saw that in core goods, which peaked in February at 12.4 annualized, or down to 6.9. And of course, when we saw PPI and even the Chinese manufacturing PPI, which by the way has fallen from over 10% last October down to less than 1% now, it's clear goods prices are headed headed significantly lower. Of course, we know with Walmart and Target having a bunch of trailers in their parking lots that prices are probably going to head lower still on goods. But even service sector inflation momentum softened over the last 3 months, including shelter. Now, most people will look at the shelter measures and start to think about how they're constructed and say, well, it'll take at least 6 months for that to flow through. But there's been a pretty serious shock to the housing market. And, we've had a 20% drop in activity and a roughly similar sized drop in housing supply, which is kind of another issue, right? I mean, the Fed wants to weaken demand, but not supply.
Right.
But having said all that, you look at the major components for inflation and they all on a 3-month momentum basis are coming off. So, yeah, I've been calling for peak inflation for several months now and noting that the market has picked up on that for even longer. Um, the question is, how far, how fast? And I've done some pretty serious scenario analysis looking at all of the major components, what contributed to decades of disinflation, which really can be isolated all into the goods category, right? This was the integration of China and the Soviet bloc into global supply chains,
Yeah.
and goods prices in the US throughout the 2010s averaged zero. In the 2000s, they were even weaker. Service sector prices were above three. Energy prices, we know, were weak last decade because of the shale, oil revolution, technology revolution. But that's a different story this decade. So when you think about that one category that was almost solely attributable for the Fed not being able to meet their target, that it's very unlikely that we're going to have similar levels of disinflation around goods. So when I look forward into 2023, what I see is inflation likely stalling at 4%. Um, Between now and then, the markets will respond quite favorably to falling from 8.5 on headline CPI down to something more like 4 into the first half of 2023. However, when we stall out in 2023, that's going to be a big question for the Fed and how they respond to it, and how the markets respond to it. For me, the most obvious trade around that is to fade the rate cuts in 2023. And when we talk about growth, which I'm sure we will, I'll explain why I don't think that that's such an issue as well. But
And Barry,
on the inflation front, I definitely think it has peaked.
And like this is what makes this game that we play in terms of the market so interesting, is because there's so much nuance in terms of the timing and what's built into the market and what could possibly happen that you just explained. And I tend to completely agree with you that inflation's coming down over the short run, and yet what we're going to see is over the long run, we're going to have the problem of inflation stick with us for longer than we expect. Yet, if we look at what the market's worried about, it almost seems like the market's worried about the exact opposite. They were worried that the Fed was going to have to go and crank rates, continue to crank rates at 50, 75 at a clip because inflation was running out of control today. And then they were actually had priced in cuts next year because inflation was going to be gone by then because the economy would be into a recession / hard landing. And what you're basically almost arguing is we should almost expect the exact opposite. Pretty
close, actually. And I'll tell you, the realization or epiphany I had recently about all this was, and I've talked about it for some time, I've been on the record as saying, I think that the terminal funds rate, as high as the Fed can go without really seriously slowing growth, is more like 4%, not the 2.5% that we stopped at in late 2018. And I think it's important to go back and look at that 2018 period to understand the context for this. And so in 2018, we did indeed have a housing market slowdown, something like a 20% drop in new home sales, existing home sales, housing starts. Interestingly, those declines looked almost identical. What happened in 1987? And you might think, well, that's kind of arbitrary. It's really not. In 1986, we had a major tax law change that lowered the top marginal tax rate from 55 to 28. It caused a one-year disruption in the housing market because the mortgage interest deduction lost a lot of its attractiveness, right? Mortgage rates were 10. So we went from 5% after tax to 7% after tax, right?
Oh, I didn't realize that. Okay.
Housing got hit. In 2018, we lost the SALT deduction in regions that had high property taxes, like where I used to live in New Jersey or New York, places like that. And when you look at what happened to housing in 2018, and there was Fed studies even on this, it was highly concentrated in areas that lost that tax deduction. You also had an increase in the minimum standard deduction that made the mortgage interest deduction less attractive for first-time or lower housing value buyers. So again, that was the real reason why housing softened in 2018. The second thing we had go on in 2018 that ultimately led to the Fed's mid-cycle easing in 2019 was the trade war. And the trade war caused a global manufacturing and trade recession. It was the first time that global trade went negative on a year-on-year basis, with GDP still expanding and none of the rest of the world in recession, since they've been tracking this data. And so that disruption actually is the primary reason why the US Treasury curve wound up inverting in 2019. So those two policy shocks were the reason why really the economy didn't really hit the wall. All it did in the US was slow from 3 to 2. However, that's the reason why part of the reason why the markets reacted so badly to that 2.5% level on funds, while the Fed was also engaged in QT. So my assumption is most people just had that in their mind, that once the Fed gets to 2.5, then anything after that would have to be reversed.
Okay.
So when we got to 2.5 this summer in July, the market said, okay, well, the Fed's going to keep going, but if they go another 100 basis points, they'll have to take that 100 basis points back. And for me, that's wrong.
So you think the market just assumed that the terminal rate is 2.5, and you could almost argue that Powell believes that the terminal rate is 2.5 as well because of his comments about that we're at neutral.
Well, he thinks it's at least the neutral rate, right? But
right.
Ultimately, I think they believe anything above that will slow demand, and it's not really clear that that's the case. I'll give you another related concept to think about that I wrote a report on this week, and I talked to Kelly Evans on CNBC about it as well, which is there's this concern that productivity has turned negative in the U.S. Well, if you calculate productivity, which of course is a residual between economic output and hours worked, using GDP, it surely was negative in the first half of the year. However, the reason that GDP was negative in the first half of the year, first, supply chains cleared, and we had the biggest surge in imports in the month of March in this country that I could find since the 1960s. So a huge surge in imports. And then we had in 2020, we had the biggest drop in inventories as a percent of GDP during the pandemic. And of course, GDP plunged since 1949. So inventories were getting rebuilt, and they increased $188 billion in Q1 and only $81 billion in Q2. So that caused GDP to turn negative. What's really important here, though, for me, is GDP is not a good measure of economic output. Gross domestic income is a much better, really measurement method for thinking about total output, right? So we take the income of the household sector, the income of the corporate sector. That's what drives capital investment. That's what drives consumer spending. GDI was positive in the first quarter, 1.8%. Nominally, it was over 10. It looks like we have half of the data roughly so far for Q2. And the household sector was again over 10%. And it's likely the corporate sector as well was over 10% as well, given 10% corporate earnings and some drag from international, currency translations, which wouldn't affect gross domestic income. So GDI is likely positive. And if you measure productivity using GDI, productivity is still positive.
Okay.
That for me largely explains why corporate margins are well above prior cycle peaks, where they peaked out in 18 and early 19. And sales per employee in the S&P 500 is surging. So it kind of solves a lot of mysteries if you think about productivity a little differently. And it just paints a picture where if productivity is indeed expanding, not contracting, the speed limit, the amount that the Fed could raise rates by without slowing growth is significantly higher than the market thinks.
That's fascinating. Do you think that's also might be the trap that a lot of these analysts are falling into when they say S&P earnings are too high, they have to come in, it's not reflecting what the economy is seeing? And yet, I kept hearing this, how S&P earnings had to come in this quarter, and last I checked, we're beating S&P earnings estimates. And
That's by quite a margin, actually, and in
right.
particular in the value sectors or cyclical sectors. So yes, this is absolutely my answer to all of that. Was I thought the pandemic was two things. I thought it was an inflationary shock, but I also thought it was a positive productivity shock. Late in the 2010s, productivity was really starting to accelerate in the service sector, primarily because we ran out of bodies and companies started substituting capital for labor. I always use a great example of Starbucks, where their comp sales had stalled out in the middle of the 2010s, and they invested money in their app and got a third of their customers to buy the coffee, skip the line, and solve their queuing problem, right? And then their comps took off. So, but the pandemic actually accelerated that process. And if you look at the total amount of output today versus people employed pre-pandemic, it's significantly higher. So it has to be that, we're doing more with less. And
So everyone just took the Starbucks model, what they had figured out in 2010. It's happening across the board in all industries.
it is, some more than others. Leisure and hospitality is the one that really stands out, where wage growth is something like 9%, but employment is down 20, and total sales are 20% higher, right? So we've all been into restaurants where you order on iPads, and they finally just got to the point where they couldn't throw bodies at their problems anymore, and so they started using technology. And that to me is a concept that's going to, or a theme that's going to broaden out as we get through this whole rebalancing process. Excessive goods purchases last year, now the surge in services demand this year, and I think that's muddied the picture for quite a few people.
So when I'm thinking about how the market is currently positioned, and the fact that most people, or I would say many investors, had assumed that the Fed would basically tighten into the next recession, and now all of a sudden, with the idea that inflation isn't running quite as hot as everyone had anticipated, and maybe the Fed can pull back at the rate upon which they tighten, we all of a sudden have this monster rally in the S&P because people are underexposed. A lot of people are saying things like, oh, it's a bear market rally, you got to sell into it, you sell into it. Where do you stand about this rally?
So my forecast at the beginning of the year was that the markets had gotten way ahead of fundamentals through the course of 2021. I was looking for a significant pullback, 10 to 12% last fall when the Fed started the tapering process. That's sort of standard Fed policy normalization related corrections. And the market powered through it. But it was very clear at the beginning of this year that we were going to have a significant reversal in liquidity being poured into the market. And I can explain that, and will explain it a little bit, but that during the first half of the year, we were going to have this liquidity drain that was going to put the markets under a tremendous amount of pressure, but it was going to be interpreted as signaling, dark economic times ahead, but there was going to be a significant divergence between core fundamentals and market prices, right? And in fact, the real divergence was 2021. And what happened was likely to happen in the first half of 2022 was a convergence, right? And so sort of fundamentals hanging in, growth would slow but not be slow. And certainly on a nominal basis, it isn't. But the markets would really struggle. And it very much played out like that. So it did go down, admittedly, more than I expected. I had penciled in, looked at all these Fed-related corrections and thought, okay, well, the range is 20% on the downside to, roughly 8 to 10% on the best case scenario. I thought we'd be somewhere in the middle. And sure enough, we had a doozy. But then again, in some ways, I shouldn't be surprised by that, because the amount of stimulus in 2021 was greater than anything that this economy had ever been injected with, including during World War II. So, that's how things unfolded. But when I started to think about, okay, well, how do we time the low? How do we find the point when things really start to inflect? And I wrote a report recently, I think captured this pretty well, titled "Pivot is the Wrong Word." If I had a dollar or had to drink a beer for every time I heard pivot on television, I'd be absolutely obliterated. But the point is that if you go back to that 94 aggressive 94 cycle, the inflection point, peak hawkishness or peak tightening expectations came when Greenspan shocked the market with the 75 basis point hike in November. The market struggled for a week or two and then absolutely exploded. Now, the Fed wasn't really communicating in the same way those days. Some meetings they had statements, some they didn't. But the real pivot didn't come until a Greenspan speech right before the June 95 FOMC meeting. If you waited for that, you missed a tremendous rally because the market had just exploded from late 94 all the way through 95. So for me, that moment came at the June FOMC meeting, and you could see what happened to the terminal funds rate as priced by, Fed funds curves or Eurodollar curves. It had gone from 320 and round about May when they went to 50, it jumped to 4% and then went right back to 320. And so that 75 basis point rate hike was the maximum point of tightening expectations, and that was the inflection point. And so it doesn't bother me that the Fed's going to continue to tighten. We don't wait for the Fed to stop. We wait to get past the point when we're most concerned about that tightening. Ultimately, the Fed doesn't really drive the economy into the ditch. Thinking that Powell is the next Volcker is a little bit naive. I was studying economics in college in those days, in addition to playing soccer and drinking beer, just as an aside. But, it took 10 years for Volcker to be possible, right? The politics of inflation built for 10 years, not for one. So the Fed is not going to drive us off the cliff the way they did in 2000 or in 1981, 82, nor do they likely need to. But that's, for me, that was really the inflection point. So, when I look at, has the market bottomed? Was that the end of it? My answer is unequivocal. Yes, we reached peak inflation and we reached peak hawkishness. So beyond that, the markets will turn around and work their way through all this. And probably I would expect them to make back the first half losses through the second half. 2023 becomes a different story.
All right, we'll talk about that. Actually, I was going to say, Barry, I was thinking about you, and the last time you were on our show, you had mentioned this, the number of Fed-induced corrections that have, and I think you had said that these are often, they occur, they're 10 to 15%, and this is what you should expect. And I can't remember, you had all the stats about how often they occur during a bull market, and it is something that happens often. I was thinking about you when I was looking. I saw this Ned Davis research piece, and what they had shown was they had taken an aggregate of all the corrections in the S&P 500 that were greater than 10% or something like that, and they had plotted the composite of the times of the action of the market action on all the ones that the recession occurred on, and all the ones that the recession did not occur on. And what's amazing about it to me was it was almost the same for the first 10, 15%, meaning you can't really tell the difference.
Right.
And then you get the bounce, and that's what we're experiencing. And now you get the bounce, and you often even got the bounce in the recessions. And where it differs now is on the non-recession times, it just takes off and continues chugging higher, whereas the recession goes back and tests the lows and things like that. What would be your pushback to somebody who is convinced that we're going to, that the economy is worse than it seems, we have so much debt, blah, 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 all the typical FinTwit doom stuff, that is convinced this recession is here, and you're kind of oblivious to it? What would you tell them for somebody who is pessimistic and worried about it, that we are going to have this recession?
So there's a couple of ways to address that. First is something at least I thought was amusing that I wrote a little while back. When I was back in college, I remember the famous Paul Samuelson quip, who was Larry Summers' uncle. that the stock market's predicted 5 of the last 9 recessions. So I started thinking about that and realized, since I became conscious of economics when I was studying it in the early 80s, there had in fact been 5 recessions and 4 20% decline plus at least false alarms. And so I thought, boy, that was really prophetic. Samuelson had no idea, right? And I thought this was going to be the 5th false alarm. But from a broad macroeconomic perspective, there's a couple of issues you raised in your question. One is the debt, and I've written about that recently too, because there's a big difference between now and prior to the global financial crisis. Prior to the global financial crisis, we had excessive debt in the household sector and the financial sector. Non-financial corporate sector, not so much, and we still don't. Typically, when you get above 90% debt to GDP in any one of these sectors, it becomes unstable or unsustainable. Since the global financial crisis, we had a tremendous amount of socialization of the debt from the private sector onto the government's balance sheet. So we've gone from 30% roughly debt to GDP for the US government to over 100 now. There's very different economic implications of debt in the private sector versus debt in the public sector. And I hear this all the time. I think Mohammed El-Arian is famous for calling this a highly leveraged economy. Where the debt resides matters a lot. If it's in the private sector, it is for sure deflationary, right? That's the single biggest observation of financial crises. When Carmen and Vince Reinhart presented an abridged version of It's Different This Time, Reinhart and Rogoff's book, to the Jackson Hole Symposium in 2010, the biggest takeaway was the 15 financial crises they'd studied post-World War II was they were followed by a decade of disinflation. Okay, so but the debt, as I said, is not in the household sector anymore. It's not in the financial sector. It's not in the non-financial sector. It's in the government sector. Right. That's inflationary, not deflationary, right? It has very different implications. If the government's going to drive us into recession, typically the way they do it is with a tax hike. So LBJ did that in 1968. He slapped a 10% supposedly temporary tax surcharge on corporations and individuals. That was his last act before the party told him not to run. It's not that different than what the Inflation Reduction Act is all about, right? So I don't think that's going to age very well, like a bad tweet for President Biden, but different story. So bottom line is the debt is the unsustainable debts at the government level. That's different than unsustainable debt at the private sector level. The second point I would make is that, as I noted, gross domestic income, which is a much better measure than gross domestic product, income is what drives investment, drives investment in labor, it drives investment in capital. That's still positive and looks like it's continuing to be positive. So, and I look at the broad economy. This is a very different environment. The final point I would make about this, something else I've written a lot about, is the recessions during the Great Inflation, 1970, 73, 75, 1980, and then 81, 82. Nominal GDP kept rising, even though real contracted. The associated earnings declines were much, much smaller than our last 4 recessions. 1990 recession, commercial real estate collapse, bringing the savings and loan industry with it. We know what happened in 2000 with the tech sector. Again, a lot of that was financed through the banking system. There needs to be a banking system connection. And then, of course, the housing crisis, pandemic is sort of a special case, but earnings would drop, 30+% in that case where there's debt built up in the banking system. But even in the 16-month long 73, 75 recession or 16-month long Volcker 81, 82 recession, S&P 500 earnings only went down 13%.
And do you think that's a function of the fact that we're measuring real GDP and then earnings are all nominal?
Yes, correct. Yeah. And that's why, to some extent, equities are real assets, right? It's why you compare the equity risk premium to real yields, because the book value of those assets rise over time. Their earnings are nominal, but the book value still rises over time. And what you find when you go back and look at the 60s is that equities were a pretty good hedge for inflation up until about 4%. So in 1968, inflation had been grinding higher through that whole decade. It jumped after the passage of Medicare, Medicaid in 65, got to 4%. At that point, the equity market earnings growth had been strong, call it 15%. Valuations had stayed high, but at 4%, all sorts of bad things started to happen. And that, for me, again, is the key level for next year is can we get back below 4 at, the average inflation rate for the U.S. in the 90s when we had this absolute capital investment boom going on was 3.5. So 3.5% inflation in this country, if it's stable, the standard deviation of it is low, is not a bad place for equity investors. It's not very good for bond investors, but
Right.
And that was the story of the 60s was bond returns were negative, equity returns were positive until we got through 4 and then all hell broke loose.
Okay, you mentioned in here, you kind of alluded to the fact that 2024 or 2023 might not look as good and that the story might be slightly different. And I heard you quoted the other day, you said something about the fact that you agreed with Neel Kashkari, which doesn't happen that often.
Yeah.
What do you agree with Neel about?
Well, he's been trying to push back on the rate cuts that the market has priced in for 2023. And I agree with that for two reasons. One is because I think inflation is stubborn, but also because I don't believe that the terminal funds rate or speed limit for the U.S. economy is a 2.5% policy rate, that the economy can sustain or withstand significantly higher rates, in which case there'll be no reason for the Fed to be cutting rates in 2023. So that's what I agree with Neel Kashkari about. But it brings up a fascinating point, which is finally, and I read paper after paper at Jackson Hole symposiums about how powerful the forward guidance tool was. And anybody in the markets, back in my days at BlackRock and all, we just thought it was comical. This promise, we would keep rates low. I mean, they totally hung themselves out last year with the substantial progress pledge, and they're out of that business right now. So I chuckled about all the Fed speak since the last meeting, in as much as we haven't heard from anyone from the leadership, right? No Powell, no Brainerd, no John Williams. We've heard a bunch of forecasts from various Fed regional presidents. Well, they may have regained credibility with respect to their ability or willingness to fight inflation, but they surely have not regained credibility on their forecasting. And so all you're hearing is Neel Kashkari's forecast, which, don't care, right? None of us should care. Watch the data, and then we'll figure out what the Fed reaction function is. Have your own forecast for where the data is going, and that's how you'll get ahead of the markets. And for me, like I said, I've been looking for peak inflation for some time. I've dissected every bit of the components. I've got a correlation matrix of the components. I've got the same thing in housing. I've been convinced that inflation was peaking for several months now, and that the Fed would follow once they completed this front-loading process, got up to what they believed was neutral, and then would start slowing things down.
And so one of the trades that you've talked about taking advantage of this is trading the fact that the front end of that curve, for example, in the Eurodollar futures market is actually inverted.
Right. That's right. So this has actually come in about 15 or 16 basis points this week alone, 13 this week, actually, last 5 days. It was the DEES 22-23 steepener, which is now inverted by 51 basis points. And a literal interpretation of that is wherever the Eurodollar curve is or Fed funds are on December of 22, they'll be a half a point lower at the end of 2023. And, that was even higher. It was closer to 70 basis points a couple of weeks ago.
I think it's crazy that I'm actually shocked that the market has inverted that part of the curve for so long and has been so stubborn with it.
Well, there's the part of the issue. I mean, the broader inversion. If you go further out the curve, it's funny. I heard Barkin on CNBC today, and he was talking about, he was saying, I really focus on real rates. I thought, oh, that's interesting. And when he talked about why real rates were so low, he says, we need to get them up. He didn't mention the Fed holds a third of the treasury market or a third of the mortgage market. I mean, that's why real rates are so low. So if you plot the real rate curve today versus where it was in late 2018, 5s and 10s are 80 to 85 basis points lower than where they were. So the funds rate got to the same level, but those 5 and 10-year real rates are 80 to 85 basis points lower. I was urging them to be more active with their balance sheet contraction. Remember that the pandemic policy easing was 150 basis points of rate cuts and the equivalent of 250 billion of rate cuts in asset purchases using papers, that Fed officials have talked about, presented at Jackson Hole as kind of the guesstimate for, the relative impact. But then when they started unwinding the policy, even though the vast majority of the easing was through asset purchases, they decided to do that passively and be very aggressive about rate policy. So this just causes the curve to invert, which works at cross purposes with what they're trying to accomplish, because the one area that they really can do anything about is cooling off house prices, which they created an absolute frenzy in. And they're priced off the back end. So moving up the front end, it's funny, like the Fed seems obsessed about causing a taper tantrum. The spread of Fannie current coupon mortgage rate to the 10-year swap rate went to its widest level ever back a month and a half ago. The MOVE index, right, short-term vol index, created by Harley Bassman, who's a really smart guy, that went to its highest level since the global financial crisis. The stock market went down 24%. So they wanted to avoid a taper tantrum, but they got an even bigger one than 2013 by doing things this crude way that they did it, which was to jack up the funds rate and barely touch their balance sheet at all thus far.
Okay, so let's talk about that a little bit. I would contend that it not only is their lack of quantitative tightening right now a problem, but I would say the fact that they had promised quantitative easing, and remember when they were busy and everyone was saying you should get going on the hikes, and they said we can't get going on the hikes until we're finished the quantitative easing, and we have a plan for quantitative easing based upon we've already announced that. So you remember it was one or two meetings that they had to wait for their quantitative easing to be done before they could tighten. And I kind of shocked that this idea that they can't do quantitative easing while they're raising rates is so ingrained and so like it's almost like a religious item with them that they feel they just can't do it. First of all, do you agree that was a source of their delay in tightening and ended up being one of the big problems with how far they got behind the curve?
Yes.
Okay. So that is correct. Do you, if you were there, would you have cared that you were doing quantitative easing at the same time you were tightening rates? Like if you were on the Fed, would that have been an issue for you? Do you buy their argument that you shouldn't be doing quantitative easing while you're raising rates? Because I think it's complete bullshit, and that the reality is they're two separate things. And once you have interest on excess reserves and you made a floor system, it doesn't matter anymore what you're doing with the balance sheet.
Well, let me start by saying, had I been at the Fed last year, say middle of the year, when I was encouraging them to stop, there would have been three people in the room that had ever been in the same building as anyone ever trading a bond. That would have been Rich Clarida, who's a consultant at PIMCO, but never managed money, and Rob Kaplan, who at one time ran mortgages at Goldman and knew the market. He was the only guy at the Fed that had ever really traded a bond. So they have a massive misunderstanding of the implications of their asset purchases. So they thought they couldn't stop cold turkey because they did in 2010 and they did in 2011, QE1 and then QE2. Those are, very different examples. and they immediately went to runoff, and there would have been a million ways for them to just stop without tapering the asset purchases. Then once they should have ended that much quicker, obviously, and they could have ended it cold turkey. The market would have been just fine. Remember, at the beginning of this year, the real 10-year Treasury yield was negative 110 basis points. It's like all-time lows, just a crazy level of price setting. So to this day, if you look at the models for term premium, which is supposedly the model that shows you the risk you're taking for going out in time and duration, the 10-year Adrian Crump and Monick term premium model is at negative 80 basis points. The only time it was ever larger, was more negative than that, was in March of 2020. I mean, that includes the 60s, 70s, 80s. This is just crazy policy setting.
Okay, so now let's get to the next part of this, which is quantitative tightening. You highlighted that they use quantitative easing as a policy tool, yet the moment that they're going and unwinding it, they're like, no, we can't use quantitative tightening as a policy tool. We have to set it on automatic pilot. Why do you think they believe that? Because I'm completely with you. I think if you're going to go and move your quantitative easings up and down based upon markets, why aren't you doing the same on the quantitative tightening?
First of all, I think there's an underappreciation at the Fed of the distortions they do to the capital allocation process by intervening in the most important price in the global capitalist system, which is the rate on 10-year treasuries. It's not the overnight rate. It's the 10-year treasury rate, right?
Okay.
I mean, every central bank in the world has to hold some of them. That's how so many of our assets, our long-term loans are priced. So I don't think they understand what they're doing by setting that, artificially suppressing that price. I think that they had, first of all, the taper tantrum, they seem to think was some disaster. I had meetings on that at the time with them, and they still were convinced it was some disaster. I looked at it and I said, the stock market went down 8%, right? You had some widening of spreads. The move that you had in 10-year yields, in real yields, in bond vol were the same exact size moves that you had in 2004 when you started the tightening process then. This is what happens when you hold the balloon under the water and then you let it go. Markets move. So can you just,
for those who aren't familiar, explain to people when you say the taper tantrum, when that was and what had occurred?
Sure, absolutely. So in 2013, in fact, the day it started was a cool day for me because I was in London in the Mayfair area seeing all the big London hedge funds. And I went around and told everyone that I thought Bernanke was ready to pull a plug on QE and they were going to probably start backing away from it. And sure enough, he gave at the press conference that day, he said, yeah, we're ready to start ending the asset purchases. And you had about 120 basis point move in about 6 weeks in 10-year treasury yields. It was mostly the real yield that went, not the inflation yield. Bond volatility spiked. Stocks fell 8%. Emerging markets came under pressure. All the sort of stuff that happens when the Fed starts tightening policy. It just wasn't that scary an event, but they have it in their mind that it was just the worst thing that ever happened.
Okay, so they're inherently scared about it, and is that why they refuse to use it as a policy tool? And or one of the reasons, the main reasons why they refuse to use it as a policy tool and want to just put it on automatic pilot?
It is, but it's incongruous and illogical because they use the tool so aggressively when they get to the zero lower bound, and then they refuse to unwind it aggressively. For example, right now, and I've heard this Harley Bassman talk about the convexity profile of the mortgages that the Fed holds, right? They're mostly 2 and 2.5% coupons. Jamie Dimon would probably buy, I don't know how many he would buy from them. I mean, hundreds of billions from them. They've got all this excess cash in their balance sheet. Those are great assets. Those bonds, the problem with a mortgage bond, as you know, is it can get called at any time, but not if it's a 2 or 2.5% coupon, it can't. So, it trades at a wide spread, and it's a good bond. The Fed could sell those bonds. The market would scoop them right up. But
And do you think that, okay, as the Fed goes and does QT and puts it where we should be doing what, 35 billion a month? Is that what the current thing is? And we're going to double it next month to 70? If I got the numbers right.
It's going to go to 90, 95 actually.
Maybe I'm missing the treasuries. Okay.
Yeah, but they're not going to get anywhere close to that because mortgage prepayment speeds are slow and they won't get the prepayments on mortgages. And those two things are very different because treasuries, when they expire, those are by definition short-term securities, right? Because they mature, and right before they mature, they're one-day securities. So that's a liquidity effect. And we should talk about liquidity a little bit. But mortgages are long duration assets. When people move their home, they pay down that mortgage. The duration on that underlying bond or underlying asset could be 8, 9, 10 years, as calculated based upon what the rate is and all. So that's actually putting duration back into the market. So it has a different effect, the mortgages versus the treasuries.
Okay. Okay, so let me get this straight. What you're saying that there's going to be two elements of the quantitative tightening. One is the fact that as treasuries come off, that's just a liquidity side.
Correct.
But the other thing is that we're going to have a situation where, are you saying that they're actually going to sell those mortgages because they're not going to have enough mortgages that it kind of pay down? And
they will never get to the maximum caps if they don't sell them outright. But
do you think they are going to sell them outright? Or
earlier in the year, I thought there was a chance they would.
Yeah.
They're not. They're no longer talking about it. They're not providing any sort of hints that they might. They should. I think it may be considered in the first part of next year. Once they go through 3 months of being at the maximum caps and don't get anywhere close to their cap on mortgages, they may start considering selling them outright. And that would have very different effects. So if I could just step back for a minute on the broader QT implications, there's 3 channels for quantitative easing that get reversed with quantitative tightening. There's this liquidity effect when the Fed buys those bonds. The offset to it, or the liability that gets created, is bank reserves, right? It's cash in the banking system.
Okay.
So in 2018, when they were going through QT, the banking system held $1.2 trillion in cash, and the infamous Fed RRP program had 0 in it.
Okay. Today,
bank reserves, or bank cash assets rather than reserves, are 2.1 trillion. That's down from 2.9. And I want to explain why it's down because it's subtle and interesting point. But the RRP program has $2.2 trillion in it.
Right.
So in total, there's $4+ trillion in excess liquidity in the system. Maybe the floor on that is somewhere around 1.5. That's when we had that repo problem in September of 2019. But that would still leave, $2.5 trillion in excess reserves at least.
Okay.
At the Fed's current pace, it'll take 2 years to get anywhere near that floor that we were at in 2018. So liquidity is not really an issue. I'll add to that the biggest liquidity injection and most aggressive injection in 2021 was not the Fed, it was the Treasury.
Right, with the TGA.
So Mnuchin had built up $1.8 trillion in his account at the Fed called the Treasury General Account.
Yeah.
Yellen had barely gotten her security clearance when she announced they were going to drain that, which meant first they sent checks to individuals and then they stopped Treasury bill issuance. And so she injected $1.7 trillion into the system, basically into bank deposits and money market deposits from February of 2021 through September of 2021.
Yeah, it was unbelievable amount of liquidity that got shoved out into the system.
That's right. So in the first 4 months of this year, they rebuilt that balance from basically 0, $50 billion or so, to $950 billion in the first 4 months of this year.
Okay. Now, so Barry, you've highlighted this. Do they not understand what they do to the liquidity in the system and the financial markets by yo-yoing this account up and down?
No, apparently not. Apparently not, you know?
It's crazy that they're doing this. Like, because I remember learning about this and when in Obama's time, and those numbers were tiny.
Yeah.
Like they were tiny, and now they've just gone and these numbers just go crazy. So I didn't realize they'd run it back up. So that also could be part of the reason that the stock market and risk assets have struggled for the first half of the year.
That's absolutely my view, is that when that liquidity drain started at the beginning of the year, that is what initially buckled the markets. So I'm arguing that the liquidity component of QT, as we reach the maximum caps, will basically, we've already had the liquidity shock. So that's the liquidity channel. The Fed balance sheet contraction is so passive compared to what the Treasury did in both 2021 and 2022 that I'm really not worried about the liquidity component. There's the second effect is the setting of rates, of long-term rates, called the so-called stock effect of their holdings. We've talked about that, right? The fact that real rates are at the 5 and 10 year points of the curve are 80 basis points lower than we were in 2018. That's the piece that's still mispriced. And that's a piece I would bet that those rates are going to move higher. And then the final channel is the portfolio balance channel that flows all the way through to equities and spread fixed income assets and all. Stock market went down 24%. So we already had our taper tantrum. As I said, mortgage spreads went to all-time wide. Stocks went down 24. Fixed income vol spiked. They've already had the taper tantrum piece. So all that's really left in terms of the impact of QT is the impact on longer term rates. And that's what I would focus on. I don't think it's going to be a shock because of the way they do it, unless they're willing to sell mortgages outright, because the Treasury piece doesn't affect duration. Only the mortgages do.
Okay. And why, though? I guess I'm a little confused about why QT will cause the real rates to rise at the longer end of the curve, because they're not buying the new treasuries anymore.
Yes. So there's the stock and the flow effect, right?
Okay.
I mean, the flow effect should already be complete because they stopped buying assets in June, right?
Okay.
So that should make real rates drift higher over time. But as mortgages mature, that will put duration back into the market, and that will put pressure on longer term real rates. So it's really the mortgage piece that has the most impact on the longer part of the curve, which is why, I've been urging to be more aggressive about that, to actually consider outright sales. They've talked about it. Lori Logan, who went from head of the Soma portfolio, now she's going to be head of Dallas Fed. She's talked about it. A number of the other bank presidents have talked about it. Esther George, for one, thinks they ought to be more aggressive about that. But there really doesn't seem to be a consensus. And it's not surprising because, if you were sitting around that table and realized there's not a soul there with any experience in capital markets. I mean, there's no one that was ever on the sell side, on the buy side. There's professors and people that have worked at the Fed their whole career is what the Fed is.
One of the things that hasn't really gotten much traction yet, but I worry about, is that for years and years and years, the Federal Reserve owned all these assets. Their liabilities were overnights and other things like repos, and those were always lower than the what they were earning on their portfolio. Eventually, if they keep raising rates, we could have a situation where instead of them remitting to the Treasury, they're actually asking for some money. I was just wondering, have you noticed people starting to think about that? And do you agree that central bank theoretically could have negative equity with no real consequence on the economy?
Yeah, there's been a fair bit of discussion about it. I've written about it. Others have talked about it. I've heard Fed officials say that it will not be a constraint on policy tightening, but above a 3%, call it 3/4 policy rate, their portfolio starts to carry negative. Here's the rich part. It gets booked in government accounting as a deferred asset. The losses are a deferred asset. Is that rich? I mean, I don't know. Maybe it's just my geeky finance sense of humor, but that strikes me as really amusing. But let's face it, if the Republicans are in charge of the House or the Senate and the Fed's portfolio starts carrying negative, someone's bringing it up, and Humphrey Hawkins, that's for sure. The other piece of this, though, that's important is every 100 basis point cost of Treasury finance is equivalent. So right now, the total marketable debt in the U.S. is about $24 trillion. So 100 basis points is $240 billion. Remember, of U.S. outlays, which were roughly $6 trillion last year, only 30% of that is discretionary. The other 70% is mandatory. Social Security, Medicare, Medicaid, all that stuff. Yeah. I know we don't have universal medicine like you, but we kind of do. You just have to be 65 or have your income below a certain level to get it. Anyway, that $240 billion is 13% of discretionary spending. Tell me that doesn't become a problem when that interest starts crowding out everybody's pet project that is how they get elected.
And I've talked and written about this, the fact that Paul Volcker, he rose rates to 18 whatever percent, but at the time the debt to GDP was a small portion.
Correct.
And it was 25% debt to GDP. I think that the rise that Powell has just done as a percentage of change to the Fed's or to the Treasury's out of money pocket is the same as what Volcker did.
That could be. Wouldn't surprise me. I haven't done that calculation.
Yeah, because it's a much different environment. It's easy to raise rates when you're only 20% or 25% debt to GDP. When you're 120 or whatever the number is, that ends up costing a lot of money. Now, ultimately, I look at that and I say, this doesn't mean that we're going to have higher rates. This means at the front end, this means that we're going to have lower rates. There's going to be more excuses to not raise rates as much as we think we need, or as much as should be done. Do you agree?
I do. Yeah. I do. Ultimately, I've said on a number of occasions that there is no way the Fed will push as hard from above their 2% target as they pushed from below.
Oh, that's a great line.
It was costless to push from 1.5 to 2, but pushing from 3.5 down to 2, it'll be really brutal because of some of the reasons we've discussed.
Let's talk a little bit about that, the new act that the government has passed. Biden's taking his victory laps about. You've said something to the effect that buyback is a dumb tax. Can you tell us why and kind of what your general opinion about this new act and what it'll mean for markets?
Sure. So I have two primary issues with the act. One is the buyback tax is foolish, and I worry that it's the camel's nose underneath the tent. Right now, adjusted capital investment for the S&P 500, so CapEx plus R&D, is 42% greater than the money spent on buybacks. So the whole narrative that companies are spending all their money on buybacks just falls apart when you look at the numbers. We know that it's efficient allocation of capital, and anything that gloms that up is bad for capital allocation. I'm a big classic economic liberal or Austrian guy where capital malinvestment or misallocation is a big problem. So I'm bothered by that. And Cliff Asness could probably do this better than me, but that really troubles me, number one.
Not without swearing and pissing a lot of people off, though, Barry.
Right. But the issue that I have with this. So I did a lot of work before the Tax Cuts and Jobs Act was passed on the various components of capital investment and how they're funded and what tax policy means for them. So the three components in non-residential investment within the GDP accounts or the national accounts are intellectual property products, which the government didn't even consider an investment until 2013, but clearly is investment. So that's software plus research and development. That's funded out of cash flow. It's not depreciated over anything. So it's not really sensitive to the tax rate other than the tax rate affects cash flow, right? So that's the issue there. Then there's equipment. Well, equipment's depreciated over a 3 to 5 year life. The Tax Cuts and Jobs Act created immediate expensing. Kristen Sinema managed to get a carve out for that in this so-called Inflation Reduction Bill. But equipment investment during the whole 2010s ran at about 5%, which is its post-World War II trend. So doing immediate expensing for me was like doing, I don't know, CapEx for clunkers, right? We didn't need it. It was already fine. Where we've underinvested in the US for 30 years now is in structures, physical plant and equipment. As we outsourced everything, that's really what we've underinvested in. Those assets are depreciated over nearly a 30-year life. It was changed slightly in the Tax Cuts and Jobs Act, but it's still a very long duration investment. It's funded out of debt, and it is far and away the most sensitive to the corporate tax rate. And sure enough, a 15% minimum corporate tax rate is a problem for that, right? If you're a business who's going to embark on a big plant and it could eat up a lot of your cash earnings, but now you have this minimum tax based on your book profits, it is a major negative. And so on the one hand, they passed the CHIPS Act and give all this money to semiconductor companies to build plants in the US. And then a week later, they pass a bill with a minimum corporate tax rate that runs in the exact wrong direction for bringing physical plant and equipment back to the US.
It's like blowing and sucking at the same time.
Bad policy.
And what do you think is there any market implication from that?
Not in the near term.
No.
I worry about that as being for me, it's yet another reason why inflation will prove sticky in 2023. So, if you go back and you look at my 60s analogy, when JFK spent a ton of money, guns and butter, and then decided to fix the problem by raising taxes. So it's pretty rich, actually, if you think about government expenditure paid for by taking money from the private sector. Doesn't exactly sound like a productivity enhancing proposition to me, but the Biden administration has done the same thing, right? They lit inflation on fire with $1.9 trillion in stimulus, and now they're going to reduce the budget by taxing corporations, particularly affecting physical plant equipment when we're trying to restructure supply chains and strengthen, de-risk them.
So does that, at the margin, does that make you a little less positive on stocks? Like if you're thinking about allocating,
it does for 2023, but there's
not for today, not for the trading allocation.
I think there is a very strong case for a very strong capital investment cycle. We had the weakest capital investment cycle since the late 50s, and that was a short one through the 2010s. So we've underinvested. We've underinvested in our physical plant. It hasn't made economic sense to manufacture in China to sell stuff back in the US. Economically, since 2015, we've had a series of supply chain shocks. These companies are going to do it anyway. And furthermore, I'm not sure how long that tax is going to last anyway. But yeah, on the margin, it troubles me. It's a negative towards my broader strong CapEx cycle thesis.
What about the U.S. dollar? How do you see that shaping up right now? Obviously, the consensus had become quite bullish, but with the easing of the inflation worries, are you thinking that we could return to kind of a more liquidity plentiful U.S. dollar going down environment?
I'm going to come at it from a little bit different angle, which is I think there was a sort of a come to Jesus moment for the ECB and Europeans and the Germans in particular, that their mercantilist policies that they really began with their labor reforms in the 2004 or 5 timeframe no longer work. And so they've been so reliant on selling capital goods to China. That business has absolutely collapsed. They were the center of globalization, right? I mean, getting their energy from Russia, selling their products to China. Every time things started to weaken, well, let's have a weaker euro, so that'll boost our exports and get us out of trouble. Well, the dollar from the 70s through this latest decade was something of the anti-petro currency, right? So the crude prices would go up a lot, and the Can dollar would go up, and U.S. dollar would go down. If you think about dollar regimes, dollar was weak in the 70s after the end of Bretton Woods. The U.S. started running energy trade deficits. In the 80s, Reagan deregulated the energy sector. Oil prices crashed. The dollar screamed until the Plaza Accord. The 90s again, energy was generally weak. The dollar was strong. And in the 2000s, it all culminated in a $440 billion energy deficit in 2008 and a weak dollar through that period. But somewhere along the way, we had the shale revolution and the U.S. started running energy trade surpluses. So when energy spiked earlier this year, the dollar went up along with the Can dollar and Norwegian krona. So that created a huge problem for the Europeans because of their energy deficits. And so the ECB is now in a spot where they can't let the euro sink. And I think the first mover on ending the mercantilist model, which remember economies 2, 3, and 4 after the US are very much mercantilist, export dependent economies. China, Germany, Japan. So I think we hit a real inflection point where they realized that just relying on a weak euro to try and solve their problems is actually making their problems worse, and they're going to have to move away from that. So sort of a long-winded way of saying I think the big move in dollar euro is done. Now, we get to next winter and energy starts to become a problem again, which is reasonably probable. The ECB is going to be in a really tricky spot. So could you have another impulsive move down to 90 or so on the euro? Wouldn't shock me. Could the Bank of Japan in another energy squeeze get forced to actually abandon yield curve control? If there's going to be a trigger, that's going to be it, right? It's going to be energy. So, as far as the dollar against kind of everything else, I mean, yes, we got past this maximum point of peak hawkishness as I've been describing it. So you'd think the dollar would start to lose some of its fans and start to settle back into a range. And, EM currencies should do better. But even EM currencies, you can't really view them as homogeneous, entities, right? I mean, they're all very different situations. The LATAM situation is different from Asia, different from Europe. So I hesitate we kind of go down a rabbit hole talking about all that.
Fair enough. All right, Barry, I've kept you long enough, but before you go, I thought we'd chat a little bit about your life. I'm always curious to guys that used to work on Wall Street and have decided to live a little bit of a simpler life out in the great outdoors. What's that been like? Tell us, you've moved from New Jersey all the way to Colorado. Is that right?
So in 2005, when I got my 2000 Lehman Brothers Stock Award, we've been doing family trips out to Colorado and Wyoming and Utah. And I was absolutely determined I was going to buy a home. And I took that 2000 Lehman Stock Award and bought the home in 2005. It's the single best trade of my entire career.
As long as you didn't borrow against it.
No.
You sold the stock and bought the home. Okay, that's
right. So my daughter went to CU. My niece and nephew went to CU. They all live out in Colorado. I've got 2 boys. One's in New York. It's going to make us grandparents, so we'll be going back there fairly frequently. And the other one's on tour. But we just had this option because we were empty nesters to move to our second home in Vail, and it's been just amazing. One of the things that kind of shocked me about living out here is the amount of toys that you need to buy, right? So, I already had my skis, but I had to buy a bike. I had to buy special skis with skins on them so I could hike up the mountain after the lifts closed and then ski down. I was already playing a lot of golf, but playing more golf. I had to pretty much hang up my soccer boots after 50 years because, there was over 30, 40. I played open division till I was 38, over 30 till I was 48. I was playing over 40s back in Jersey, and I just signed for what was probably the best over 50 team in Jersey before the pandemic hit.
You just signed what, were they recruiting you?
Yeah, they did. And so out here, I'd have to play with 26-year-old,
Oh,
Mexican
guys that are going to
kids
take it
or
way
whatever.
too
And I was
seriously.
like, I don't think so. So I did end my soccer career, but otherwise, it's an amazing place to live. And market closed a little earlier, so that's nice too. But
I got to ask you, because I'm a big skier, and I love going cat skiing out in I stay up here in Canada. We go to BC, in the interior BC, but I'm increasingly feeling like as I get older that I appreciate climbing up, and I've wanted to go touring. And
yep.
when we do cat skiing, we would do the skins, like the cat would take us, and then we would have to skin certain sections and stuff. So it's not like I'm new to it, but I've never gone from like the bottom all the way to the top. Are you doing like a full day of hiking?
No, I mean, what we've tended to do is, we'll wait till the mountain closes, and then we'll go up like a 2,000 vertical foot incline, and then take the skins off and ski back down, either with a headlamp if it's early in the season, or if it's later, then it's still light and you ski down. And I haven't done too much off piste, mostly just going up the groomed lines. It's a heck of a lot easier going up something that's been groomed
for sure.
Still a good workout. I mean,
I can imagine.
15 minutes or so to get up there, and it's a big time calorie burn. So it's fun. But
and have you? I was looking the other day at some. I have a YouTube subscription, and it serves me up different things depending on what I watch. And I watched something, and next thing I know, I was getting all these Jackson Hole videos, and I had no clue about the crazy stuff that's like inbounds there.
Yeah,
like
Corbett's is nuts. I haven't been to Jackson in probably 20 years, and I wasn't all that good a skier back in those days. I mean, I grew up skiing some, and we were coming out once or twice a year, and so I've done like Alta shoots at Jackson and that sort of thing, but I've never done Corbett's, and Corbett's is pretty crazy. You take the tram up. I will probably drive up there either this year in the winter. I'll get some friends and we'll take a trip and
okay. Well, you have to let us know if you did Corbett's. We'll have to get you back on to find out.
Yeah, to talk about Corbett's.
All right, now Barry, I'm not going to let you go without promoting your new podcast that you have. So why don't you tell people about Ironsides Macro, what you do, and you have an institutional, more flavored product, but you also have this new podcast that you're giving a whirl. So why don't you tell people about it?
Great. So I my background is Lehman Brothers derivatives and then principal trading. Then I became the equity strategist. I did that job for 6 years at Lehman and then Barclays. Worked at BlackRock as in fundamental fixed income, helping manage the unconstrained fixed income funds. Had a similar strategy job at Guggenheim, but started Ironsides Macro and wanted to broaden out the client base a little bit. My notes do research can get reasonably complex. We had a fairly complex discussion today. And so, the institutional client base likes it for sure. And then I have more relationships, but even for the purposes of some of the institutional clients that aren't as focused on macro and liquidity issues and QT to the depth that I focus on it, I started creating a weekly podcast, which was based upon the note that I'd written that I spend a better part of a day and a half at least on Thursdays and Fridays. And it'll be a 10 to 15 minute summary of that and just kind of simplify it and make sure everyone understands the concepts and what it means for the markets, what it means for equities, bonds, and how to understand all the macro comings and goings. And so I've decided that I had a tremendous amount of interest in that podcast, and I was using it primarily just to promote the written product. But I also understand, as you guys have certainly learned, that there's a tremendous amount of people that like audible learning, right? Would
Yeah.
love to listen to podcasts and just prefer to do that. And so I think there's an audience out there. I've made it much more approachable in terms of price. It's $10 a month, which to me, for someone with my background, seems like a pretty good price. But obviously, macro isn't for everyone. But
Yeah, I mean, well, listen, at $10 a month, you give it a whirl. I signed up. I love hearing your voice. I love hearing what you have to say. I think that your take on markets is it's so much it's filled with so much logic and so much non hyperbolic type of FinTwit doom stuff that you'll find, that I just love it, because it really does feel like you're on the sell side and you're listening to a proper macro strategist that's talking about it in all seriousness, and it's for $10 a month. You can't beat it.
I appreciate that. So everyone can find it at ironsidesmacro.supercast.com. The regular written publication is ironsidesmacro.substack.com. But for the podcast, it's Supercast.
Yeah, and you can, and just for those that are interested, if you sign up, you can listen to it on all your regular players. Somehow, I don't know how it does it. It figures out, it gives you a link and allows you to go listen to it on Spotify or your iTunes playlist. So it's super simple to do.
Awesome.
Well, Barry, thank you so much for coming back on the show. We really love hearing your views. Have a great summer, and we'll look forward to getting back and finding out how you did on Corbett's.
Thanks, Kev.
Okay, take care. All right, Patrick, it's time for Talking Charts. What do you got for us?
Well, okay. Well, let's actually start off with talking about the top three things we were watching last week, and we were just highlighting crude oil and its current down move, and whether or not there was another leg lower, or whether or not it was going to bullishly turn. And well, it kind of did not too much of anything. I mean, it did break to a lower low. Let's just quickly put it up here, and then quickly shot right back up into the trade range. Overall, each rally is sequentially a lower high and a lower low, in still in a downtrend. But we're at some pretty important support lines down here in the mid 80s. It'll be really interesting to see still whether or not this ends up being the bottom end of the range, or whether some of those bold forecasts that some of the big macro guys are doing of like $70 oil comes to fruition.
Oh, is that coming around? So now all of a sudden there's all sorts of bears coming into the woodwork?
Well, I mean, I think, correct me if I'm wrong, I think it was Zulauf said $70 oil, and then there was another one. I'm trying to remember. There was a couple of big macro guys that were calling for it. It wasn't just Marco, right? It's
yeah. Well,
but anyway,
Marco
the thing is
rethink it, because he's got some company now.
I kind of look at it from a different perspective for oil, though. I look at it and say every dollar you get oil cheaper here is $1 closer to its swing low. I don't think the big picture trend is over on the upside, and so I almost welcome a short-term dip here so that I can load up at better prices. I don't know.
There you are. You're talking like your the diamond hands of crude oil.
Well, I wanted to go a little cheaper first, right? Yeah. So I'm not. Anyway, I'm going to diamond hand crude oil. I'm not saying that. We'll
Number
do that.
two.
How about you? Are you going to?
I don't know. I don't have a real opinion. Oh gosh, U.S. dollar. You put that on there again.
That was last week.
Oh, okay. You snuck it on.
Yeah, no. What do you mean? We talked about it. Like, don't like you're pretending you
didn't got
remember.
Me in a moment of weakness and he was allowed to put in there. No,
we were asking whether
it's really important.
Yeah, but we were talking about whether that short-term little rally that was happening last week was actually a turnaround in the dollar, and we needed to see the Dixie breaking 107 on the upside, and it didn't. This consolidation continues, but what's interesting is it's a bit of a mixed bag where it's coming from. Like, for instance, that obviously that U.S. dollar yen is one that you keep an eye on. That's been more volatile, but if you really kind of look at things like the euro, it did have one up day, but it gave it back. The pound sterling couldn't even make a higher high from its high from 2 weeks ago. It's still too early, I think, to put the nails in the coffin of this dollar advance. We'll see whether or not the bulls can turn it around here, but I'm not ready to write off the dollar just yet. Any thoughts?
Oh, well, I just love hearing that.
Really? Well,
I'm on the other side of all that. I think it's those charts look great. I don't see what you're talking about. Euro looks fine. It's grinding higher. pound, it wasn't that bad.
You just made me sick to my stomach.
Yeah, that's what makes a market.
There you go.
Sold to you, buddy. Number one, inflation. Oh, it was finally, we got one right in that it was a top three thing to watch.
Yeah, it was, and the fact that it showed
the first big miss to the downside, right?
Well, yeah, it's the first, and that's going to start killing all the rate of change models and everything. And certainly, inflation is paused momentarily. I mean, ultimately, inflation will over many months start to tame if it just comes in flat, right? The year-over-year changes come.
Remember, Biden told us there was no inflation this month.
Yeah, it's true. There wasn't.
Well, what are we watching for?
It certainly helps the fact that wheat prices and grains and stuff like that are all 20, 30, 40% off their highs, and the oil's pulling back. Like, it's an environment where it would have been natural to see some sort of tick on the CPI and come in, right? But anyway, it is happening, so we'll see how long that lasts. So, top three things to watch this week. I snuck this one in here, but I'm watching that yield, and I don't want to
guess. You're bullish on bonds for a change.
Well, let's. I think that a short-term low is in. On it, but what I think will to solidify whether or not it's more of an intermediate move, like this is the 10-year yield, is whether or not this rally that we're seeing here in the yield towards 3% stays below 3%. I mean, if we start seeing the yield ripping to 3.25, I mean, always a risk of a double top and things like that, but that could really set in motion another down leg in bonds and another run. And so in order for me to stay at this neutral state where that short-term low in bonds, which is a high in yields, is in, I want to see the yield stay under 3%. But what is interesting about it, though, Kev, is like, take a look at the yields around the world. The Canadian 10-year went from 360 down to 260. Actually, a similar move to the U.S. But you take a look at that German yield. It went from 180 down to 80 basis points. It literally got halved.
You can't do that, though.
No, I know, but it's still a big drop in yields.
Yeah, okay. It's a big
right
drop.
On a relative basis to the drop in yields on the other two. The drop has been significant, and obviously a lot of talk about the Italian bonds, and you can see that after peaking out just over 4%, they were even temporarily trading under 3 on a consolidation basis. So we have all of these yields coming off, and the bigger question on my mind now that we see at least inflation slowing down, will we see that bonds are going to start counter trending and actually start moving higher and acting almost defensive in this period, even if equities are moving during that period? Any thoughts?
Oh, I think bonds are a huge sell. And I know that seems counterintuitive. Inflation's coming down, so therefore, why would you sell bonds? But I think you sell bonds because inflation's coming down, and that means that the Fed's no longer going to kill the economy and is going to grind the economy to a halt.
1 month doesn't do that, Kev.
Yeah, I don't know. I think that this is going to be a big, huge steepener is going to occur, and I think that the bond market is very susceptible.
Where? Like your 5s, 30s, 2s,
or whatever, anything like tens and out, I think are going to be in
trouble.
So,
because there's been a long extended consolidation on those 5s, 30s, but the 2s, 10s have been collapsing.
Yeah, right? But if you look at the inflation number, that was the low in that, and it's been grinding higher since. Listen, that's what makes a market. Well, I think it's a good opportunity.
It's not actually. If you're playing it from the spread like this, I have to believe that you're going to have. It's favorable for you. Like I just don't imagine this getting more negative than this. I mean, can it go from minus 50 basis points to minus 100? Yes, but at this point, is it easier to play, or from asymmetry? Is there more upside of this turning back positive and ripping higher than the downside risk? I'm totally for that. I just think it might be a little early. We'll see how long it takes to legitimize the turn, but definitely oversold enough that it could bounce the other way.
And so I think by extension, yeah, so to me, I don't think that's going to be a bull steepener. I think it's going to be a bear steepener, and that you're going to see that the long end is going to get hammered. Anyways, number two, what are we watching?
Let's see. Number two, bear market rally is well. First of all, is this a bear market rally or is the bear market over? I was just like, I was looking at the last few days of the strength after that inflation number, right? Just ripping higher. And even last week, we were talking about that 50% retracement level as kind of bear market rallies tend to be capped to that. I mean, at this stage, this is now legitimately stress testing that theory. And with this kind of relative strength on this rip, it is certainly causing some serious FOMO amongst investors as to whether or not this is all over. And the question here is this one big bear trap that higher, or is this still just a bear market rally? No, sorry, or is this a legitimate new rally?
Is it a bear market trap, or is it just a bear market rally? Either way, it's a bear market.
No. Or is it a new rally? Man, I'm just tripping over my own words.
Well, no, it's just your true underlying feelings about the stock market come out.
Well, like I know. No, sorry. Let's be clear. I have been calling all along for this to be a bear market rally. So I'm going to be spectacularly wrong if this thing keeps ripping higher. I've been very cautious about it up here. The one thing we talked about last week, which is why I think it's worth watching, is I almost feel like the real trap would be it clearing 20% on the upside. We're at 17.5% or 640-point rally off the low. To clear 20% on the upside would have to be another 100 S&P points toward 4,400 on the upside. And wouldn't it be interesting if this market got up there and got everyone calling the bear market over because we've printed more than 20% off of the lows, and everyone starts parading that it's all bull market from there, and that becomes the trap point.
Well, that could be. And I will tell you this one thing, Patrick. You're in good company because it doesn't seem like many people, in terms of prominent strategists are flipping. Most people are still calling this a bear market rally. I get on to Bloomberg, I listen to them, and everyone's still talking about this as a bear market rally. I've been more constructive, and I continue to be until I start to see people actually agreeing with me. I feel good about it.
All right. Well, good for you.
Good for you, you idiot. Don't you know it's a bear market rally?
Well, you know what? I mean, in the end, I've been cherry picking lots of longs, but I have to say that I've been cutting off some of the upside by collaring a lot of positions in here, and so
it's also I'm the first one to say that it's summer and this getting whipped around pretty good. It's in terms of on no volume.
I actually am pretty shocked by its relative strength. Like, I mean, the follow through on this has been pretty significant, but I think that's been a characteristic of the markets for recent years. Like, if you think back to the violence of the move in COVID or anything else, it seems like these extreme moves, both higher and lower, are more and more common.
Yeah, I that's a great observation, Patrick. And I will say one of the things that shocked me the most is the fact that they came back for all the AMC and the GameStops. Like, I would have never thought that those rallied.
Meme stocks are right back in. Yeah.
Like I don't know how about you,
but it's a hit or miss on which ones, right? I mean, sure, some of the meme stocks are going. Like I can't believe Bed Bath and Beyond, a retailer, is considered a meme stock, but the thing has been ripping off of its lows. But so many of these, I think those traders that are looking for jamming up lots of volatility in their moves, if they're going to be right, they want to be spectacularly right, are chasing and squeezing these types of stocks, right? Because they're the ones that are.
I just didn't think they'd be able to. I really didn't. I thought that the damage and the distribution, the shares out there wouldn't be able to do it. You know who had a great. Sorry, go ahead, Patrick.
I was just saying, my biggest shocker is that they're able to do it these meme stocks, but Bitcoin isn't moving like this. You would think that if it was about chasing, things that can be squeezed and really run, then you would think that this type of a move in these types of stocks would bring back the fever in crypto. And at least it's not that Bitcoin isn't off of its worst levels, but I mean, you would think that the stock it's trading more like ARK than it is trading like a Bed Bath and Beyond, right?
Yeah. You know what? When you said bring back the fever, all I could think about was don't feel I need more cowbell. I got a fever for more cowbell. That's exactly how you said it. By the way, Paulo Macro, one of my buddies here, he had a great tweet thread about the bubble echo, and I thought it was actually spot on and explains why the AMC, the GME are rallying. And if you're interested, make sure you go check him out because he had a great thread that went through why that is occurring and that this isn't as surprising as we might think. Even though I was surprised, he sounded like he was well ready for it. And if you're interested, go check him out. Number one, what are we watching?
Well, there's the minutes coming up from the FOMC next week.
And I got to look this up, but it always seems like these days they always rally into those. Don't you find that? Like, I don't know how much you watch it, but I watch the action. It always seems like we rally into the FOMC minutes. It doesn't seem to make any sense, and maybe I'm wrong, and someone will statistically say you're full of it, but that's what I found. So we'll see. Like, it's Wednesday afternoon or something, right?
Yeah.
At 2:00.
Yeah, we'll see whether or not it follows through a little bit more going into that, and whether that becomes a significant turn point for the summer.
There we go. Oh, yeah, there we go. There's the bear trying to figure out. Might be the top right there.
Wow. I said a turn, not the top. My goodness. You're now putting words into my mouth. You're trying to trap me. You're the one trapping me.
All right. The bear trap is getting trapped. Okay, so what are we watching for? What do you got planned here?
Just looking at some charts. We obviously mentioned crude oil, but I just want to highlight, like, what's interesting is crude oil making lower highs, lower lows hasn't really legitimately turned. But what is interesting is a lot of energy stocks like XLE, just as a ETF proxy for them, is getting a tailwind from the broader stock market and see that correlation to oil seems to temporarily have decoupled, and these energy stocks are actually pushing higher. And the question is should we read into that in some way? Is that a fade on the energy stocks, or is that an indication that oil's not going to go that much lower?
I've been harping on this for a while, Patrick. I think that the front end of the curve, it's so steep on crude oil that it's doing its own. It's behaving like it wants to on its own, and the energy stocks are gonna trade completely different. I think that
Really?
I've been saying this for a while. I think you could get the long end of crude oil rallying while the short end or the front end sells off, and energy stocks rally, and everyone's confused because it's energy or
just that you're just talking about a flattening of the backwardation, right?
Yeah, and so you just like imagine oil went down to $75 and everyone's like, oh, I got to sell energy stocks. But meanwhile, nobody at most of those energy stocks are not priced off the front end of the curve. They're priced off the whole strip of the longer end. And so if you had the situation where the curve actually got steeper again, they would do better. So I've been saying this for a bit. I think energy equities are much better to own than crude oil futures. And if you are going to own crude oil futures, make sure you own out the curve. That's my
you know one of the interesting things, I want to just kind of move on to another sector, which is the transports. This is the transportation ETF, but they have been just ripping. But what particular interesting thing is that it's the rails. I'm just going to pick on Canadian Pacific Railway, but you can pull up any of the rails. The rail stocks are ripping right back to 52-week highs. It's like there's no bear market or a recession in the rail business.
That's a great point. Actually, I missed those stocks. That is kind of shocking.
Like
how well
all of them have got some. They just come back to life. And it's really interesting to see. And it's kind of not captured because the other transport stocks like FedEx and UPS and things like that have been dragging their heels, and a few other names. But generally, and especially the airlines, have been actually. Let's quickly peek on the Jets index. But like obviously. The airlines have been big laggards, but the rails have been working.
And Patrick, I think that's a great opportunity to highlight that everyone's focused on the previous indexes that everyone was trading, or the previous sectors that were the hot things. And there's going to be more and more of these types of things that just rally without anyone really paying attention. And, let's face it, a dollar is a dollar. And whether you buy Microsoft and catch it for 10%, or you buy some railway and catch it for 10%, the money's the same. And I would counsel everyone to stop looking at the previous winners and start looking at what's winning now. And it sounds to me like we're getting some rotation into some new winners, like things like railways.
And but if you're talking those meme stocks, but we'll talk about one of the sectors that's ripping. Utilities are going right back.
Yeah, and listen, I know I'm kind of I contradicted myself there, because the meme stocks are ripping, and people are chasing those. But that to me feels the meme is like that's a different animal. I still think that if you go look at the previous winners, I meant like things like Meta and Microsoft, those aren't leading the same way that rail stocks are.
Yeah.
And so, if you want to do a trading sardine, fine, go trade the meme stocks and just be aware that you're trading something that's crazy. But if you're doing investing and looking for the winners, I'm just saying that I think that the FANG mats that were previously the things that everyone loved, they're not the ones leading on this rally. They're not the ones that you're highlighting here. It's weird things like railways.
Yeah.
Or are you going to bring up? Are you allowed to bring up home builders?
Yeah, well, sure. You know what? But actually, you know what? Home builders have been edging higher, and kudos to you for being long tons of them. But what's interesting is that there are other kind of. Actually, hold on. Well, first of all, let's talk about the home builders. The home builders themselves have been running really well. I mean, they've been just edging higher. But I mean, would you say that that's a huge recovery relative to some of the other indices?
To be fair, like they're grinding higher. But considering how bearish everyone is on them, it's kind of interesting. Because every day I wake up and everyone tells me, this home builder is having trouble. This lumber yard's not selling anymore. There's no demand. And then I just keep staring at the stocks going higher. And I'm like, I don't know. I'm not trading headlines. I'm trading the stocks.
The one that actually kind of caught me by surprise is I was looking at how bad the financials were lagging, and I thought it was a sign of bearishness. But look at what happened to regional banks in the last 3 days.
Yeah.
Like they just blasted off that inflation print, and suddenly this is a new bull market in regional banks. Look at the intensity of that rally. That's
a great point, Patrick. Like they're cheap though. This is what I've been saying for a while. These things are cheap. Everyone hates them. They're down and out. Nobody can imagine anything except another recession. A lot of these things were priced for a lot of bad news. And when the bad news wasn't as clear, they're like, well, shit, we better get it back in.
Yeah. The other area which I kind of like is the biotechs. They're sort of my to what home builders are to you. I've been looking for that huge downtrend to inevitably shift. I mean, they were unfortunately caught with the NASDAQ sell-off, as many of them have 4 letters on the NASDAQ, and many of them don't have profits. So when unprofitable tech was eating it, biotech felt the pain, right? And it pretty much got halved. I mean, the IBB hasn't been, but if you look at some of the smaller cap biotechs, many of them have got wiped 70-80+% off their highs, and it'll be interesting to see whether that's a turn in the biotech space.
Well, you've been great to highlight that. I think you were actually the one that pointed that out for me, and I've been also trading it from the long side because I think it's it's doing really well. It will be it'll be interesting to see, Patrick, if there's going to be a new leg higher in this thing, because it's no longer like it's paused recently. Wouldn't you agree? It's not leading, and I hope for both of our sakes, because I also like that sector.
Yeah. The other thing I wanted to just mention was these semiconductors. Obviously, there's that chips drama and all the, not drama, but all the legislation, and as well as obviously Nancy Pelosi loading up that got some buzz. But what's interesting is that it took a little bit of a hiccup here earlier in the week and recovered it. But when you take some of the individual components, like let's say Intel still broke to a lower low. So, some of the different components are still dogging it. Like even Nvidia had that disappointment and kind of dropped and gapped down, but it's been somewhat recovering. The bigger question for me are these semis bottoming, and will they actually create a short-term opportunity here somewhere?
I'd love to hear your take on Intel, because actually that's one I've been bottom fishing and risking with some fingers on, and maybe I'm wrong.
Well, I mean, look, anytime you have an earnings disappoint, it forces some big players that don't want it on their books anymore to do some selling. So usually in the week or two after a disappointing earnings, there's always room for it to just be weak. It doesn't have to be a huge downdraft after the gap, but it tends to drag. But it will be interesting to see if this is sort of like the turtle head below a support line, where it makes a quick recovery back to 40 in the coming period, and then doesn't make lower lows, and then it'll start to look like that in the Nvidia chart, right?
So I'll be in the doghouse with Morris, and probably you as well. Because I just last week I was, or maybe this week, I think it was this week, I was just selling puts.
Sure.
Just naked puts. Although you're not like Morris. You believe in selling puts at times.
Yeah.
Yeah,
I sell puts all the time.
Yeah, you're right. So it's just Morris I'll be in trouble with. I'll have to listen to Dad get mad at me for selling puts again.
Yeah, there you go. But what I was going to just ask you about, just touching on the VIX. So VIX is now coming to the bottom end of a 1 year range. I mean, okay, it could still go a few points lower, but we've now had much of that tailwind that comes from volatility contracting. But the period in the post-COVID period had volatility trade, in the mid to high teens. In general, do you think that we stay in this upper level in this period, or do you think that there's room for volatility to go even much lower?
That's a good question, and I'm glad you didn't do any technical analysis on the VIX. Otherwise, we would get in all sorts of trouble from the vol crowd, right?
It doesn't make sense to do. Anyway, let's change that.
Okay, can VIX go lower? Yes. Do I think? I've said for a while that I thought that there's that stocks don't need VIX. Stocks higher doesn't necessarily equal VIX lower. And a lot of people tell me I'm wrong about that, and then I point out to them, 1998 and 1999, when in 2000 when stocks rallied and the VIX stayed high and elevated, and they're like, oh, okay, crickets. So I think that it doesn't have. I could very well see, Patrick, a rally with a VIX that stays elevated. Having said that, I don't know how to define elevated. What are we right now? What's the number there? Because I can't.
19.5.
19.5?
Like, do you think we'd stay in the upper boundary of the high teens, or do you think there's a chance that if things get bullish enough that we go to a low teens environment where we were before the COVID period?
No, I don't think we're going back to low teens.
Okay.
Even though I'm bullish as heck on stocks, I don't believe we're going to low teens. I think there's going to be lots of risk and there's lots of volatility out there.
So I want to leave the last chart.
Well, you're not going to tell us what you think?
On the VIX?
Yeah.
I think that we're not going to go down into low teens as well. So
Oh,
it
geez, we
definitely
probably
means it
just
is.
we it would
Yeah,
means we're
it
just going
means
to
it is now.
single handle.
No, listen, our listeners know what to do when
Exactly.
you agree.
When we both agree, everyone knows what to do. Go
Yeah.
do it.
It's a new low vol regime coming.
Yes.
Anyway,
Vix takes it 3. Yeah. Okay. Anyways, go on.
so I wanted to leave it with the nat gas futures,
Oh.
and I just wanted to highlight that I think the $9 level is pretty darn important. And this is a pretty impressive 2-day little push higher in nat gas, which out of a bull flag formation could be a continuation pattern higher. And I think if we clear 9, which we have not yet, so I'm not making the bull call yet, but if we see any follow through above 9, I would not be shocked if we saw not only fresh highs, but even $11, $12 on the upside. It would be really interesting to see, and that's why I'm going to be watching that $9 level, whether the bulls can follow through on the last couple of days of bullishness.
From your lips to God's ears, Patrick.
Well, you put your strip back on?
No, I just own that. I own the equities, but I'm too scared now to buy the strip again. I probably should have.
The fact you're scared is probably a sign you should do it.
Yeah, you're probably right. The hardest trades are the best trades.
Exactly. All right. That's all I got, buddy.
All right. Talking charts. So now we're going to go to skin in the game. Now, I don't even remember what happened last week.
No, it was a euro, and you clipped me.
Oh, yeah. Oh, yeah.
It's my.
Why don't you tell people? Read it out. Say my name.
Kevin took the over on the Euro USD on Friday's close of 1.018, and immediately it went right in your favor. Now it's backed up in the last couple of days, but it never once really I was not in the money at all. Like it literally just has been all week.
Okay, I'm just kidding. I'm not trying to Game of Thrones you there.
Yeah,
what was that? Remember that? Right. Do you remember that? You watched that show, right?
Game of Thrones, yeah.
Yeah, remember when there was
that show I ever watched?
That one guy who would eat like an apple and like do things. He was a terrible guy.
Oh, let's not talk about it.
Anyways, yeah, okay. Yeah, because you know what he did. Okay, Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by next episode. And we changed the rules recently. We're going to play a match to 50 points. The loser of the match will take out 3 lucky or unlucky, depending on how you think about things, Market Huddle listeners for a dinner where they can grill him about why he had so many bad calls. Each week, Patrick and Kevin will be able to bet anywhere from 1 to 10 points, even though they're both wimps and never go above 5. Once someone hits the 50, they will win the match, and the loser needs to start figuring out restaurant reservations. Lena will somehow pick the 3 Market Huddle listeners randomly. We'll figure out those details when we get closer. But listen up, the pool will definitely include no stupid question submitters and side effects submitters. Okay, Patrick, so it's up to me now. I get to pick a... Right?
Yeah, you've been on a roll, buddy.
You know what I'm going to do?
No,
I don't. You seemed very sure about yourself on the bonds. I'm going to have to go there. Listen, I was worried.
On the yield or on the bond?
Well, I don't care. Whatever you want to pick.
No. You're picking. You're making the bet. Tell me what you want.
We'll do the 10-year future.
The future.
Yeah, okay. Let's do the future.
Do you want me to? I have the continuous right here.
No.
Do you want to do continuous, or you want which month you want?
The proper September future.
Okay. Oh shit!
There we go.
Up here.
And I'm gonna just, you know what? I'm not gonna be cute about it. Up or down from here.
Up.
All right. Okay, so wait, by the way, someone was telling us that we're idiots and that we said we had bet 5 and we'd really only bet 4.
Yes. Is
that true?
There was a listener that had made a spreadsheet for us. Thank you.
Oh, thank you very much.
Twitter at Casey Basks.
There you go. So
he's like, awesome. You guys, I'm not counting right.
See, now you know what? He's getting good brownie points on making the to the dinner.
That's right. That is the kind of stuff
this is the kind of stuff that we consider, right?
We say it's randomly, but we all know it's not.
But
Lena's gonna pick who she likes best. Okay,
Yeah,
no.
so you better impress
All
me.
right. Thank you very much for that. So it was 4 points. So it was me trying to sneak an extra point. Oh, so what is the score right now, by the way?
So that's last week. So if it was 4 points, it would be 12 for you.
Okay, so 12-5. Oh, yeah, because Patrick was busy trying to catch up. I thought we did even more. It wasn't 4 last week, wasn't it? Didn't Patrick up the?
Yeah, it was 5, but you have to minus 1 point.
Oh, I see. Because the okay. All right. So Patrick, how many do you want to do again? Because we're getting close.
I'm ready. I'm ready for another 5.
Well, I'm not going to disagree. You want to do 6?
Ooh.
I'll give
No,
you a
I think
chance.
5 is a nice clean number.
Okay.
We don't go over 5 on our bets anyway.
You're on then. Another 5.
So 119. Is it?
It will be.
You say spot 13 when it's bonds. What do you say when it's?
I don't know. No, you don't say spot. You just go what one. I think you'd say 118.13 or whatever. I don't know.
119.13. There you go.
119.13. It's my my slip of my tongue has it a whole dollar lower because that's what I want. Okay, well, this will be hilarious if we changed it to 50 and then we're at 50 basically before Halloween because we keep betting too big.
There you go. We're gonna slow it down and afterwards.
All right. Okay, Lena.
Are we ready?
It's time for No
some
Stupid
I
Questions.
think we're ready for no stupid questions.
Yeah, Lena, hit us with the first one.
All right. So first one here. Good day. As a dumb log truck driver, I have some questions. Lena, why do you
Wait. He's got questions, but I probably have even more about a log truck driver.
Yes. Probably.
Like how do they keep it on there? Like there's so many things I want to know. So maybe we could ask if we answer these, will he give us a little kind of reciprocal action when I want to know about the log truck driving?
Yes. If this is your question, please write us again and let us know if you'll answer Kevin's burning questions about logging. And this listener is also the listener that submitted the side effects from today. So
Okay, great. Thank you very much.
all right. So good day as a dumb log truck driver. I have some questions. Lena, why do you watch bad shows? You should watch Meat Eater.
What is that?
That's another show. I'm assuming it's about eating meat. It's safe to say.
Never know.
I think it's a show that maybe vegetarians and vegans don't want to watch.
Okay.
That's what I'm assuming. I'm not sure. But
Yeah.
Kevin or Patrick, because I can't tell the difference. Do you just eat moose or is bear on the menu? If not, you're a wuss. Kevin or Patrick, who or where do I learn more about discounted cash flow? Thanks.
Now,
So I do not eat bear. I do know people.
I have not eaten bear either. I've eaten a lot of different game, and bear was one of them. But I had a chance.
It's kind of like eating like dog. Doesn't it feel like just wrong to you?
Yeah.
I know.
My-
call me a wuss.
Yeah, my brother-in-law nailed one last year, and I wasn't around. They had
What he does in the
bear
privacy of his own bedroom is his own.
Buys Lacey
his
Hunt
own.
poster.
He nailed it. Okay. Have you eaten moose? So you've eaten moose, though, right?
Oh, of course.
Yeah.
You were about to come over on moose steaks, and what are you going to ask if I ate moose?
Okay. Yeah. So you've had moose. I don't know if I've had moose. I've had elk. I've had obviously.
Yeah,
venison.
I've never. No, didn't I give you a bunch of moose?
No, you never. You fell down. You
I swear I was
going to
give you
big
some of the
game, and
moose.
then you just fell down. You moved to Portugal.
Yeah.
Yeah. What are you allowed? What's the situation with taking moose steaks to Portugal?
It doesn't happen.
No?
All right.
You're not allowed to do that. Like
No,
that's
I
like,
had to eat it. I ate the entire freezer full before I left. So that was
all right.
perfect.
Okay. And on to the real question: where do you learn about discounted cash flow? Little do most people know, but I'm actually a CFA.
What?
And yeah, it's strange, and I don't have a clue. I've forgotten where you learn about that, and I don't know about.
Well, I mean, you
your-
could take the CFA, or you could.
That's
take,
right. So you know what? I think he's got some. Maybe he could get CFA on audiobooks and study while he's driving his log truck.
Well, it also depends, I guess, on what degree of analysis you want to do. I mean, if there's just understanding, the metrics and how it's calculated, estimating, the expected future cash flows, discounting them back. If you want to just understand in principle, you could do it on YouTube. But if you want to go and actually take apart balance sheets and do the calculations yourself, it's CFA, except no substitute, right?
So why don't we do this? Why don't we tell ask our listeners to tweet out the best place to learn about discounted cash flow? I'm sure someone's got a great YouTube video or some book that they say this is the Bible of discounted cash flows.
There you go.
Okay.
All right. What's up next, Lena?
All right. Howdy from Alberta.
Nice.
I began listening to the Market Huddle during the shutdowns when COVID turned off the buy button on many other things in my life that are productive and fun. Many thank yous for the crazy hijinks that helped keep me sane, as well as the insightful discussions between you and your amazing guests that kept me somewhat profitable. My question to Kevin, Patrick, and Lena is, what is on page 19 of your business section? What do you reckon is the next up-and-comer no one's paying attention to? I'm still long ornamental cords. Haven't missed the show. Love y'all. Yeehaw.
Well,
you
Lena, are you ready? Are
go?
you going to... No, let's let Lena go first. Ladies first.
What are we talking about? Page 19 of a business section? I don't read
That's
newspaper.
basically... that's like... what's
you're catching her off guard.
What I know, I'm putting her on the spot. What's your kind of sneaky buy recommendation?
Oh my gosh, you're asking the wrong person. I can't answer this question.
I know, but you could give us something fun, like, something that you like buying, like apples or something like that.
Let me think about it. I don't know. I haven't thought about that.
So my problem is my business section only goes to page 16, not 19. And the problem with that is that my ADD forces me to have a nap after page 3. And so it takes me a while to get there. But you know what? The sneaky one that nobody seems to be talking about is the imminent short squeeze in block cheese futures. It's... It's coming, and nobody, not one headline, no one's talking about it. But man, like, you think that the farmers in Europe protesting that there's like riots and stuff like that. Like, imagine if there's shortages of Parmigiano out in Italy, like. There's going to be riots. This is a huge macro event here.
There's a huge macro. Block cheese futures go limit up for 6 days until they can trade.
It's going to be nuts. Nobody's talking about it.
I will give this listener my.
You're going to try to be serious? Okay, go.
Yeah,
for
I'll
it.
try to be serious. I think that right now, the bond market is a potential very large accident waiting to happen. And nobody's talking about it, but we've had a terrible, shock, Patrick, and I'm bearish on bonds. But I just look at the fact that we've just had, 9% inflation. I don't think that we're going to go back down to sub 2 anytime soon. And yet we still have bonds yielding some just stupid level. And everyone sits around worrying about the stock market and worrying about a repeat of the great financial crisis. And I always contend that the real crises occur and stuff that nobody is ever, hedging or worrying about. And I think that that's going to be the bond market. So I guess that's my thing that I think that's on page 19 is being the poor performance of the bond market. I think it's going to get even worse, and it'll eventually be on page 1.
Why don't we put a bet on that?
No, but I'm talking about this is for like a longer term thing.
Yeah.
And
all right,
so
let's move on before you get yourself in trouble.
Do you have one, or you just like going to go?
No, I do not have one.
Okay, got it.
Okay.
I can give you a page 3. No, just kidding.
Okay, let's go.
Hello, Patrick, Kevin, and Lena. I'm a big fan of the show. You're a great company for when I'm out jogging. Anyhow, my question relates to trading political events such as elections. I put together a bear put spread strategy for trading the upcoming constitutional vote in Chile. Options seemed like an appropriate instrument for this type of trade. Would you agree? Otherwise, what type of instruments would you use for trading political events in the short run? Does it depend on whether I'm bullish or bearish? Thanks a lot. Enjoy the beers and have a great weekend.
So it's a great question.
Well, first I'll speak to the options, and then you can speak to the kind of geopolitical idea of trading events like that. But I personally always find that when you're trading political events or something big, that capturing the asymmetry of an option strategy, such as a bull call or a bear put spread, is always a way of kind of hedging out some of the implied volatility risks being put into those options, and allows you to build clean, payoff profiles for trades that if you're terribly wrong, you know exactly how bad the loss is going to be in advance, right? And so as long as you can have a reasonably liquid options chain, because like for instance, the Chile ETF ECH has some half decent options, so you could come in there and put on the strategy with some combination and be able to express your views. So I'm not opposed to using that option strategies for that kind of stuff. Anyway,
but you're saying that you need to be more than just a straight buyer of options due to the fact that the heightened volatility.
Well, he was saying he was putting on the spreads, and I was just confirming that the spread strategy is definitely, in my opinion, the better way to put it on, because usually before a big event, the implieds tend to price in more expensive options, right?
Yeah.
And so if it becomes a nothing burger and those volatility contracts, and you get what was that side effect? You get Vega
vasectomy.
Yeah, you get one of those.
You don't want the Vega vasectomy. Do everything you can to avoid those. and then ice that thing for a long time if you got problems. So for those who know me well, know that I kind of don't like trading political stuff, because I think that often people assume political events move markets more than they do. And obviously in terms of elections, that's slightly different than just saying, oh, I think China is doomed because of this, and then they have some grand geopolitical view, and they make that their number one talking point, and then meanwhile, I'll look at their fiscal policy or the monetary policy, and that's what's really driving the markets and being much more important than the kind of geopolitical, 10-year plan that they have about stuff. So that's kind of my pushback about geopolitical trading. In terms of when it comes to actual elections, those can affect markets, and they are tricky to trade. It ends up being a lot of fun, and it's not like I'm going to say that I don't end up trading them. It ends up being a little bit of a case of poker and trying to figure out what everyone else's hands are and how everyone else is positioned. And so it kind of almost isn't investing, it's more trading. And I just want to highlight that it's really, especially over the short run, it's about trying to figure out how the crowd's positioned, what everyone's assuming, how it's going to work. And then one last point is that often in markets that are extremely liquid, that have options, that the event can be a Vega kind of deflator, as Patrick has highlighted, and that in itself can affect the pricing of the underlying market.
Right.
Meaning that, like when Trump won that with 2016 was it? And it was a surprise win, and the market they sold off hard. And then by the time we got a situation where the markets were open, we started to have a decrease in volatility, and that ended up affecting the underlying market in itself. So the tail can wag the dog. Okay, Lena, last question.
No, it's not last.
There's two more this
lots?
week.
Okay.
Yeah.
Okay.
GavCal recently talked about technical impacts on bond pricing, specifically a shortage of high-quality collateral. The raised the risk that the market was interpreting the price strength, lower yields as an economic signal when maybe it is actually mainly a liquidity or technical issue. This also potentially applies to tips and hence to market-derived inflation expectations. I'd be very interested in what probability you'd assign to this view being correct and the implication if it is. Many thanks.
I think this is a great question. Obviously, GavCal and Louis do some great work, and if they're talking about this, I'm sure that is the case. And I think Barry Knapp actually talked about there's a shortage of high quality collateral, and the fact that he thinks that real rates are lower than they should be based upon the fact that QE has withdrawn many of those bonds from the financial system. I just kind of the listeners asked for us to kind of discount the probability that this is correct. I don't know how I could assign a probability to that, but I will say that I'm a big believer that there's lots of reasons to be wary of a lot of the typical economic signals that are occurring from various instruments. One of them being that we just did the most quantitative easing that we've ever done. Another being the fact that we've had 40 years of disinflation. And I think that we've moved to an inflationary environment and that the market hasn't really truly understood that. And Barry touched upon this a little bit, that the market's applying and using an old playbook for many of what they assume is going to come. And so if there was a general piece of advice that I'd give is that at moments of changes in long-term trends, and I think that we did indeed go through a change when COVID came, many of the signals or the kind of playbooks that we used in the past might not work as well. And so whether it be because of Louis, or I'm not sure if it's Louis, maybe it's the other fellows at GavCal, whether it's because of they thinking that there's a quality of high quality assets, a lack of high quality assets, or whether it's because of the fact that we're going from a disinflationary environment to an inflationary environment, there's lots of reasons to be careful about the signal that the bond market is sending. Do you have anything to add to that?
No.
Okay.
So let's go to the next question.
Last question here. Hello, Huddlers. After a close call of $4,000 of excess liquidity remaining, my futures foray continues with rice and cocoa having recovered. To avoid a future Helm's Deep moment, I was going to buy futures options on coffee. But wait, is there any actual difference between futures options on coffee as opposed to just buying options on the Joe ETF, which I have done many times before? What gives me more of what mythical risk-free alpha? What gives me more of that mythical risk-free alpha?
All right.
You want to go?
I mean, let me just highlight some things, and then everything I say wrong, you feel free to correct me.
I doubt you'll.
Well, first of all, can you just check on your Bloomberg there? If does the Joe ETF just hold the front month contracts? Or
you know what? I'm not logged in, so I don't actually know. But let me go try to find it while you're talking.
Well, you try to find it because that's an interesting thing. But I mean, the first observation between the actual futures and the ETF is going to be tracking error, if there is any. I mean, if the ETF is run really well, then maybe the tracking error is minimal. The other big thing is, of course, just matching what is notional exposure you want. Obviously, the Joe ETF is going to trade at a dollar figure with a 100 multiplier for the options versus in your other futures, you've got a size that trades based upon the contract size. So, you know, if as long as you're doing everything in line and you accept a tracking error, then I don't see it being a horrible thing using the ETF. Generally, futures offer you better margins than trading ETFs. But clearly, if you are having a Helm's Deep moment, you may actually benefit from deleveraging a little bit. Maybe
you might be looking for the White Rider to come over come over the mountains. I'll just say one thing that I just looked it up. I can't figure out what it says. Coffee. It doesn't say which futures it holds. People just need to be aware that if you go, and let's just use the USO because that's a kind of an easy one that people understand. The USO owns what, the first 2 or 3 months? I can't remember.
No, it actually it spreads it among the front 12. It's actually bought a strip. But it's weighted more to the front, obviously.
Okay, but okay. So even if it's a strip, let's just assume
it's 1 year though. So you're not going out to those longer dated ones. At least that's what I heard last time. I didn't check it recently. But
if you go by, let's just imagine that. Let's just keep it simple, just so that people can understand the difference. Let's imagine that USO just bought the second month. Let's pretend it didn't buy the first month; it just bought the second month, which I think is what it used to do, but I could be wrong. But and then you bought a 1 year option on the USO. And people think, oh, that's the same as buying a 1 year option on crude oil. And it's actually not.
Right.
1 year option on crude oil is on crude oil to deliver in 1 year, whereas the option on the USO,
because the future price on the term structure settling in January 2000 or let's say right now 1 year out would be let's say September 2023 contract, right?
Right.
And so that might be $5-6 lower a barrel on that contract. So you got you're trading a different strike. While anyway, but
the USO one, even though it's a 1 year option, it's a 1 year option on USO, and what USO is, it's a series of 1 month rolls. And that might not look the same as the 1 year.
And
option.
Almost never does.
Yeah. And so that's the thing that I just want everyone to understand, is that it's not one and the same. They are different. Long-term options on ETFs that hold shorter dated futures are not the same as long-term
whether it's
options.
backwardation or contango.
It's just going to be a different. It's going to be
you're
different.
rolling, and the cumulative returns is going to be different than the longer one. Yeah, absolutely.
There you go. All right.
That's it, Kev. I don't think we have any more. So, but
Okay.
where can they submit questions?
If you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
All right. So thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow on Twitter at the Market Huddle. Listen, everyone knows all this. I won't bother saying it again. Patrick, where can they find you?
You can follow me on Twitter at Patrick Ceresno, or find me at bigpicturetrading.com. Kev.
I'm on Twitter at Kevin Muir, or you can go check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market, we're just happy to spend some time together on this crazy ride. So next, stick around for the after show.
All right.
Okay, rate your beer, buddy.
No, first of all, I noticed that we actually didn't let Lena read the description of the beer. Do you have a second to read it, Lena? Do you still have the notes?
I gotta find it. 1 second. I had it, and then here. 1 second. Momotaro is a well-known hero of Japanese popular culture. Legend has it that he came into the world inside a giant peach that was found floating in a river by an old childless woman. How does this legend relate to our beer, you ask? Well, as in the legend, a few tons of peach were found floating in a river by an old brewer without fruit. In disbelief with such a discovery, he decided to save the peach, and using a base of, I'm not going to be able to say this word properly, Berliner Weiss, join it with an absurd amount of passion fruit to create this delicious Momotaro.
Well, yeah, this has got a ridiculous amount of peach and passion fruit. Like, this is honestly...
This is a smoothie sour, so it's thicker?
Yeah. No, like literally think of like in the supermarket when you buy one of those fresh blended juices on the thing. It literally is that color of peach juice, that thick, that texture. This is like I could have this for breakfast and not. It's got a bit of a sour taste. And it's like. It's honestly too sweet for me to have more than one. But if you like juice, you'll like this beer. It's like
they also made a point to say that this is also vegan. I don't know if that.
Oh.
Okay, give us the rating for the vegan.
Well, I would have given
beer.
it a poor score, but now that I know it's vegan, it's got to get a bonus point. But no, you know what? On the rating of sours. You know what? I'm trying to go with the. No, I'm gonna give it like a 7.3.
Oh my god!
No, but the reason that I'm not going higher is because
higher. It tastes like peach.
Yeah, but the reason I'm not going because first of all, remember we have a spectrum of scoring for sour beers that is different than other beers, right? So what I was trying to do is reflect on some of the previous sours that we featured on the show, and the problem here is that this tastes too much like juice. This is something like my kids would drink. It doesn't live up to what a proper sour beer should be, so I don't want to give it a score above 7.5. 7.3 is good. It's not a horrible beer, but it's
okay.
Just juice.
So I guess we got it. Lena, do you have any questions for Patrick for his beer?
No.
No. Okay, so let's go. Let's get on.
So let's go on to talking movies.
Oh no, I
Patrick
gotta talk
can't
about
participate.
my fish experience.
Oh yeah, how was it?
Okay, yeah. So, I gotta make sure I don't offend too many people with this. So for those who don't know, I don't really know the band Fish, and I do listen to our buddy Morris and Liam's show, and they stick like 2 minutes of Fish that they put up their phone up against it and like get this tinny Fish song at the beginning of every show, and a couple of tunes I started to like. So I decided to listen to them, and then I was like, okay, well, if I got to listen to them, I'm going to actually give this band a try. So they were coming to Toronto, so I bought tickets and I went. Okay. Lena, I don't even know how to say this. Okay. Imagine. Okay, so I don't know if you've ever been to a Justin Bieber concert, but I had young girls that were of the age for Justin Bieber, and they are very, very excited fans. Like when they're,
I'm
take
sure.
a 10-year-old.
They're screaming
Yeah, okay.
their heads off,
Okay.
I'm sure, yeah.
They got nothing on Fish fans.
Oh,
These people.
middle-aged men screaming for the band.
Oh, yeah. And so first of all, we did have a market going on the percentage of men to women. And the market was 80 to 90, 80 bid at 90. It was probably pretty correct. Probably ended up being somewhere in between there.
Really?
Yeah. I felt like, when you go Rocky Horror Picture Show, when everyone knows how to, like, they throw toast.
Yeah.
And they know what to say at different spots.
Yeah.
I felt a little bit out of place because there was lots of points where I was supposed to know what to do, and I didn't know what to do.
Morris didn't prep you for that?
No, he didn't. I enjoyed it. It was great. I'm glad I did it. You can cross it off my bucket list, but I will not be going back.
Oh. I see.
All right.
I don't want to offend too many Fish fans. Awkward, yes, I do. Morris is like, well, we'll get you. You can come with me, and I'm like, okay.
You're too Canadian to say no. Like, okay, yeah. Let me ask
It was
my
fun.
wife.
It was good. Okay, so
Let me ask
listen.
my wife. Maybe
It's
she'll
like,
let me out.
yeah. My wife, please say no. I can't go. Let me just explain to you one of my biggest pet peeves of it. It was 3.5 hours long, and I'm pretty sure there was only 4 songs. There might have been 5. It was hard to tell. Sometimes they didn't break in between the songs. It's literally like at one point I'm like, oh, is this like an intro? Are we still in the intro? It's like a 10-minute intro, then like a 4-minute song, then like a 12-minute guitar solo, and then a little 5-minute outro.
And everybody's just like going berserk, right? Like,
oh, and they just love
Yeah.
it. They just love it. And there's like every Bay Street Trader is there, and they're as like high as you can imagine, and just going. They love it. It's just it's like a farmer's market there. It's like people just love it. Anyways, so that's just long and short of it. I'm glad I went, and as I said, it'll probably be my last one. And I apologize, for all the Fish fans out there. I will say they are wonderful musicians. There's no doubt about it. It is awesome. Like the guys can play the guitar, piano, drums, bass. They're great. It's fun. I get it. I understand why you like it. It's just not for me.
that's okay.
All
to
right.
not-
Yeah, that's what makes a market.
You tried it. It wasn't really you.
Yeah, that's what I'll try anything once. But I do have a show for you, Lena.
Oh.
I would tell Patrick, but he's not going to watch it anyways.
No.
Have you heard about this show called Casual?
No.
Oh, so it's a Jason Reitman show.
Where is it on?
It's on Netflix.
Oh, it is?
Yeah, let me just check. Let's just check how many tomatoes it has before I go give it the
God.
full blessing. Casual Rotten Tomatoes. Oh my God, there's like 2 seasons or 3 seasons, 4 seasons. Oh, that's great.
Which one did you watch?
I just started with it, so I'm just on the first season. 89 tomatoes, so it's pretty good.
It's on
Anyways,
Netflix?
Yeah, I don't understand how I missed it.
I don't. Yeah. This show's been on for a while.
Yeah,
Lena finished Netflix.
Yeah,
How could
how
she have
could I
not
have
found
not
it?
yeah, that's true. I'm calling bullshit on that. I'm beginning to think she was exaggerating.
Well, that was also like last year. They've revamped
Yeah.
their content
Oh.
system. So,
Anyways, give it a whirl. It's pretty funny, actually. I've only done 3 or 4, but I
What's
really
the
like
premise of the show?
it. So it's a brother and sister that are in their 30s, and she gets divorced and she has a kid and she moves in with him, and he's like a tech kind of wonder kid that has an online dating company.
Okay.
And it's based in LA and it's fun. I think it's Jason Reitman. It's kind of really good. I think you'll like it.
Okay.
It's it's Jason Reitman type humor, like Michael Cera type humor.
Like dry humor.
Yeah.
Okay.
It's pretty good. So there you go.
I'll check it out.
How about you? You got any shows for us?
No, I actually haven't really watched any new shows. I'm like on our rerun binges. I just watched Straight Outta Compton again yesterday. That's what I did yesterday.
Straight Outta Compton, like that movie? Like,
yeah.
oh, my wife loves that movie.
She loves that movie?
Yeah.
Oh, wow.
Like it's the one with the rappers, right?
Yeah, yeah, with NWA
Yeah.
story.
Yeah, no, she loves that movie. It's one of her favorite movies.
Oh, wow.
She loves.
Yeah,
Well, that's like
it's a
my-
great movie.
Like I listen to teenage girl like university girl emo music, and she listens to like hardcore rap. Like you think I'm kidding, but like she literally listens to the hardcore
gangster
rap. The gangster, that's what it's called, gangster rap. Yeah, I know. Probably mad I told everyone, but yeah, she loves it. Anyways,
I love it.
It's a good movie though. That legit is like a terrific movie.
Legit, it's good. Yeah.
Yeah, I don't like the rap too much, so I just
You don't like the rap too much, yeah.
So, but I didn't know the story, but I thought it was an absolutely fantastic movie.
Yeah, it's a good movie. So.
Anyways,
that's all I
Patrick,
watched.
when
So, I'm just like on Twitter here, and I saw this picture. You just did an interview right there. Is it?
oh no, I did a couple of days ago.
Yeah, but you just retweeted it. But what I wanted to ask you here is, like,
Yeah.
did you just go for a new photo shoot?
No, that's my old one.
Yeah,
That's my
I
old
mean,
picture.
come on, that's a nice clean picture. I haven't seen some like this for a while. Like,
No, that's my picture I give to give. Like that's
That's
what
your
my
professional
that's
thing?
what my agency sends to all. Someone asked if it was professional. I said no. I was at in Nova Scotia or Prince Edward Island, and I gave my photo to my daughter, and I said take some pictures, and we just took one from there.
There you go.
So what do? Like you have fancy, like you went for the proper ones, right?
No,
No.
no. I mean, in
Well,
the
the
end,
original ones that we did was Luke did them, like Lena's.
Yeah, well, that's the
husband
whole
did 'em.
point. Is that like Luke's pretty good at this shit, so we haven't really gone beyond that. He just pulls out some high-end cameras, so definitely high-quality cameras, but not done by a professional, like in a studio or anything.
Yeah. No. So.
Only the
he-
Tinder ones for that. No, just-
That's right. Well, and then Luke's he's getting us, like, it was a little bit weird when he asked us to go to the urinal and pee. I was thinking, this guy's a little bit of a weirdo.
still an epic picture.
Yeah, he came up and like, look what I got them to do.
We haven't used that one for a while. We have to sneak that one.
Yeah,
into
he was
our
like, look
mix
what I
and-
got them to do. And I was
Yeah.
like, oh, great.
It just even sounds dirty when he says it. Look what I got him to do. Two guys in a urinal. Okay.
Oh, God.
Maybe on that note, we'll have a great weekend, everybody.
All right. Have a great
Okay.
weekend. It was a
Thanks
good
for
show.
tuning in. Take care.
All right. Cheers,
Bye-bye.
everyone.